Ever wonder how someone could become one of the wealthiest people on the planet? Well, today we're pulling back the curtain on the secrets behind one of the most successful investment philosophies in history. We're talking about the Warren Buffett Way, a really disciplined framework that, believe it or not, turned a tiny stake into a massive financial empire.
And when I say tiny, I mean it. This whole journey, which honestly sounds like something out of a movie, started with just $100. Yep, $100 back in 1956. And through decades of, you guessed it, patience and discipline, that little bit of money just compounded and compounded into one of the world's greatest fortunes. It's kind of mind-blowing.
So the big question is, how on earth did he do it? Was it just pure dumb luck? Some kind of magic? Or is there an actual method here? A system that we can actually learn from? Well, let me tell you, it is definitely 100% the method.
Okay, so let's dive into the first part. Before we even touch any numbers or checklists, we've got to start with the most important thing of all. It's a total mental shift. It's all about learning to think like a business owner. Seriously, this is the foundation for everything else we're going to talk about.
And this quote right here, it just nails it. You have to forget about the blinking green and red lights of the stock ticker. Buffett's whole approach is about flipping your perspective completely. You're not just trading a piece of paper back and forth. No way. You are actually buying a small piece of a real, living, breathing business.
And if you're going to buy a piece of a business, you want one that's well protected, right? This is where his famous idea of an economic moat comes in. Just picture a castle with a giant moat around it. That's what he's looking for in a business. Some kind of durable, long-lasting advantage that protects its profits from competitors. It could be a super powerful brand, like Coca-Cola, or a huge cost advantage that nobody else can match. It's that defense system that keeps the castle safe for the long haul.
All right, let's get into the nitty-gritty. How does he actually do this? How does he put that owner mindset into practice? Well, he's got this really systematic framework, 4 essential filters, and any potential investment has to pass through every single one of them. This is his secret sauce for separating the truly great businesses from the ones that are just kind of good.
And what's really key here is that it's not about just finding one good thing. It's a step-by-step process. He starts with the business itself, then he looks at the management, then the financials, and only after all of that, at the very, very end, does he even think about the price. A company has to pass every single one of these tests in order to even be considered. Okay, filter number 1, the business tenets. First things first, he just looks at the business itself. And you know what you won't find him doing? Chasing the latest hot trend or trying to figure out some super complex, futuristic tech company. Nope, he's looking for businesses that are simple, predictable, and built to last for decades.
So let's break down what these questions are actually designed to do. When he asks, is the business simple and understandable, that's not about avoiding smart companies. It's about avoiding businesses where he doesn't personally have an edge. It's about staying in what he calls his circle of competence. This whole checklist forces him to stick with what he knows and to only focus on companies that have proven, consistent earnings and, of course, that strong economic moat.
But, a great business isn't the whole story. It's not enough. Once the company gets through that filter, he zooms in on the people who are actually running the show. And why is that so important? Well, because a fantastic business can be completely run into the ground by bad leadership.
And just like with the business, he's got a very specific checklist for the leadership team. He's looking for managers who are rational with the company's money, not making emotional decisions. They've got to be honest and upfront with shareholders, especially when the news is bad. And this one's huge. They have to resist that temptation to just copy what everyone else is doing. Basically, it all boils down to one question. Do they act like they own the place?
All right, so the business checks out, the management checks out. Now it's time to let the numbers do the talking. The goal here is to dig in and find a company that isn't just strong on paper, but is truly financially rock-solid in the real world. He really zooms in on a few key numbers to get a quick snapshot of the company's financial health. A high return on equity, or ROE, that tells him how good the company is at turning shareholders' money into more profit. Strong profit margins? That's a good sign they have pricing power. And low debt? Well, that's absolutely crucial. It means the business isn't fragile. It can handle a punch. It all paints a picture of a company that's built to last, even when things get tough. Okay, so let's imagine a company has passed the first 3 tests. It's a great business, it's got great management, and the financials look fantastic. But now comes the final and maybe the hardest test of all. Can you buy it at the right price? Because let's be real, even the best company in the world is a bad investment if you pay too much for it.
And this brings us to one of the absolute cornerstones of his entire philosophy, the margin of safety.
The idea is actually pretty simple, but it is so powerful. First, you figure out what the business is really, truly worth, its intrinsic value. Then, you just wait, patiently. You wait for the market, in all its craziness, to offer you that business at a big discount. That gap, that difference between what it's worth and what you pay, that's your margin of safety. That's your protection.
Okay, so that's all the theory. But what does this whole framework actually look like when you apply it to a real company? Let's take a look at a classic case study, one of his most famous investments ever.
And just look at this. You can see exactly how a company like Coca-Cola ticked every single box. The business, super simple, totally predictable, with people all over the world wanting their product. The management, they had a long history of making smart decisions with the company's money. The financials, consistently high returns, great profit margins. And the market? Well, he bought his big stake when everyone else was pessimistic, which gave him that critical margin of safety. It just passed every single one of his filters with flying colors. So you might be thinking, okay, that's great for Warren Buffett, but what about me? What are the real practical takeaways for the rest of us? Let's talk about how you can build your own investor toolkit based on these exact same principles. You know, the biggest lesson in all of this is that successful investing has nothing to do with frantic, constant activity. It's all about discipline. It means you've got to learn to ignore the day-to-day market noise. It means you have to do your own homework, really dig deep into the businesses you buy. You have to have the patience to wait for the right price. And then you need the conviction to just hold on for the long, long term. When you boil it all down, it really comes to a fundamental choice you have to make. You can play the Wall Street game, you know, the constant noise, focusing on short-term price swings and pure speculation. Or you can adopt the Buffett way, a disciplined focus on the long-term health and the real value of the businesses that you actually own a piece of. And that really leaves us with a simple but pretty profound question, doesn't it? In a world that's just obsessed with speed and nonstop action, could it be that the most powerful advantage we have as investors is just the simple discipline to sit on our hands, be patient, and wait for that truly perfect opportunity?